The top 10% of American households hold 67% of all wealth in this country. The bottom 50% hold about 2.5%. You've probably seen those numbers before. Most articles put them side by side and then spend the rest of the piece talking about why that's unfair. That's not what this is. What I want to know is what the people in that top group are actually doing, and more specifically, what they're doing that the people just below them aren't. Because here's what makes this interesting. A lot of people in the middle aren't broke. They earn decent money. Some earn really good money. They have 401ks. They pay their bills on time. They're doing what they were told to do. But the gap between them and the wealthiest 10% keeps widening, not closing. Something is different. And it's not just income. I spent time going through the actual research on this Federal Reserve survey data, Vanguard behavioral studies, fidelity account analysis, work from the National Bureau of Economic Research. What I found wasn't a single secret. It was 7 specific behaviors that show up consistently in the top 10% and almost nowhere else. I'm going to go through all 7. I'm saving number 7 for last because it's the one that almost never gets talked about, and I think it's the one that actually drives the other 6. The first difference sounds simple. It isn't. Most people follow a sequence that goes, earn money, pay expenses, save whatever's left. The problem with that sequence is that whatever's left is usually not much. Life is expensive. Things come up. The number at the end of the month is smaller than expected every month. The top 10% run that sequence in reverse. They earn money, move a fixed amount into investments first, and then spend what's left. This isn't a new observation. But the behavioral data behind it is worth looking at closely. Vanguard publishes an annual analysis of account behavior across millions of participants. The consistent finding is that people who automate their contributions, meaning the money moves before they ever see it, accumulate significantly more over time than people who manually transfer savings. Not because they earn more, because they never make the decision. The money is gone before the brain can reassign it. There's a study from the National Bureau of Economic Research that looked at savings behavior following mandatory auto-enrollment in workplace retirement plans. When people were automatically enrolled at 6% of their salary, most of them stayed at 6%. Some increased it, almost none decreased it. When enrollment was optional, average contribution rates were around 3% for the same income group. Same income, roughly double the savings rate. Just from changing who makes the first move. The wealthiest households don't just do this with retirement accounts. They do it with brokerage accounts, with real estate down payment funds, with business investment accounts. Before the spending decisions get made, the investment decisions are already made. Automatically. If you're reading your paycheck and then deciding what to invest, you're playing the game on hard mode. The money is already sitting in your checking account waiting to be spent on something. The wealthiest 10% don't give themselves that choice. The second behavior is related to the first, but it goes further. Most working adults own a car, maybe a home, probably a 401k. That's the standard asset list. And there's nothing wrong with those things. But a car depreciates the second you drive it off the lot. A primary home is somewhere between an investment and an expense depending on the market and how long you stay. A 401k is good, but it's locked up until you're 59 and a half. None of those things generate income right now. The Federal Reserve's Survey of Consumer Finances, they do this every 3 years, consistently shows that the top 10% hold a much higher share of their net worth in things that generate cash: rental properties, business ownership, dividend-paying stocks, private equity. The further up the wealth ladder you go, the more of their wealth is working. Here's a concrete example of how that compounds. Say you have $100,000. You can put it in a savings account at 4.5% and earn $4,500 a year. Fine. Or you can put it into a rental property that generates $800 a month in net rent after expenses. That's $9,600 a year. Plus the property appreciates, plus you're paying down the mortgage with someone else's money. I'm not telling you to become a landlord. That comes with its own complications. The point is the structural difference. One asset sits, one asset works. The wealthiest 10% have a higher percentage of their money in the second category, not because they found some secret investment nobody else knows about, because they made a deliberate decision to move money out of things that just hold value and into things that generate it. Dividend stocks are the lower effort version of this that anyone with a brokerage account can access. A company like Johnson & Johnson has paid a dividend for 60 consecutive years. You hold the stock, you get paid quarterly, regardless of whether you're paying attention to the market or not. It's not dramatic. It's just money coming in. The mental shift is from how do I grow this number to how do I make this number generate something while it grows. This one is less about behavior and more about knowledge. But the outcome gap it creates is significant. The IRS publishes data on contribution rates to tax advantage accounts every year. The pattern is consistent. Maxing out a 401k, an IRA, an HSA, these are concentrated in the upper income brackets, not because lower earners can't do it, but because most people in the middle don't know the full picture of what's available or how to use it. Here's what the full stack looks like in 2026. A 401k allows you to contribute $23,500 pre-tax. If your employer matches, say, 4%, that's another $3,200 on a $80,000 salary. So before you do anything else, you have $26,700 going into a tax-advantaged account that compounds without being taxed every year. On top of that, if you have a high-deductible health plan, you can contribute $4,300 into an HSA. That money goes in pre-tax. It grows tax-free. If you use it for medical expenses, it comes out tax-free. It's the only account in the tax code with that triple benefit. And most people either don't have one, don't contribute to it, or spend it immediately on medical bills instead of paying out of pocket and letting the account grow. Then there's a backdoor Roth IRA, available to high earners who are above the direct contribution limits. You contribute post-tax to a traditional IRA and then immediately convert it to a Roth. The money grows tax-free from that point on. It's legal. It's been available for years. And a large portion of people who could use it don't. If you run those three simultaneously, maxed 401k, maxed HSA, backdoor Roth, you're putting over $35,000 a year into accounts where the government has limited or eliminated its ability to take a cut of your growth. The top 10% know this and use it. The people below them often know parts of it but don't put the whole picture together. I want to be careful with this one because it gets talked about in a way that makes it sound easier than it is. The data on income sources across wealth levels is pretty clear. The IRS Statistics of Income division breaks out where income comes from by bracket. At the middle, almost all income is wages. At the top 10%, wages are still the largest source for most people, but they're not the only source. There's investment income. There's rental income. For many of them, there's business income. The average top 10% household isn't some hedge fund manager with 10 revenue streams, but they do have 2 or 3. And the difference between one income source and 2 or 3 is significant, not because of the extra money in the short term, but because of what it does to your risk profile. If you have one income stream and you lose it, you have 0. If you have 3 and you lose 1, you have 2. That's not complicated math. But the behavioral difference it creates is enormous. Someone with one income stream and a mortgage and a car payment is one layoff away from financial crisis. They can't take the risk of turning down a bad job. They can't invest in a business idea that takes a year to pay off. They're locked in. Someone with wages plus $1,500 a month in dividend income plus a side business generating $2,000 a month has options. They can say no. They can wait. They can take the long-term bet. The secondary income sources among the top 10% usually didn't start as big numbers. Rental income often started with one property. Dividend income started with $5,000 in a brokerage account. Business income started as a weekend project or a consulting arrangement with a former employer. The compounding effect builds over time. What's consistent across the data is that the first secondary income stream is the hardest. Once you have it, the second one comes faster because you've already changed how you think about money. This one surprised me when I started looking at it. There's a behavioral finance concept called financial anxiety, the vague background stress of not knowing exactly where you stand. Studies from the American Psychological Association consistently put money as the top source of stress for American adults across income levels. People earning $100,000 a year report financial stress at high rates. The interesting part of that data isn't that wealthy people have less stress because they have more money. It's that the correlation between income and financial stress is weaker than most people expect. What correlates more strongly with financial stress is clarity, whether someone has a system, a plan, and regular visibility into their own numbers. Vanguard's data on advised versus non-advised investors shows a consistent gap in outcomes. On average, investors who worked with a financial advisor held better diversified portfolios, rebalanced during downturns instead of selling, and stayed invested through market corrections. The behavioral coaching piece of financial advice, stopping someone from selling at the bottom in March 2020, may be more valuable than the portfolio construction piece. The top 10% are more likely to have a financial advisor. But even among those who don't, they tend to have a personal system that does similar work: a spreadsheet, a monthly review, a clear rule about what gets invested when, a defined number for net worth targets at different ages. Most people who feel behind financially couldn't tell you their exact net worth right now. They couldn't tell you what their investment accounts returned last year versus a benchmark. They don't know their savings rate as a percentage of income. That's not a personal failure. Nobody taught this, but it means financial decisions get made based on feelings. It feels like things are okay, it feels like there's enough, it feels like this purchase is fine, rather than numbers. The top 10% are more likely to make financial decisions off actual numbers. And that removes a whole category of mistakes. This one is harder to quantify, but shows up clearly in survey data. The Federal Reserve's Survey of Consumer Finances tracks educational attainment and professional development spending across wealth groups. Unsurprisingly, higher wealth correlates with more formal education. But the pattern holds beyond formal degrees. People in the top wealth brackets report higher rates of professional development spending courses, certifications, conferences, coaching than those in the middle. There's an economic return argument here. If a $2,000 certification leads to a $15,000 raise, the math is easy. But the more consistent pattern is the indirect return. Skills that enable income diversification, networks that open doors that weren't visible before, knowledge that changes what you're willing to attempt. Warren Buffett talks about this in a way that sounds almost too simple to be useful. He's said consistently that the best investment you can make is in yourself, that your skills and knowledge can't be taxed or inflated away. The reason that sounds like a bumper sticker is that it's been repeated so many times without the mechanism being explained. The mechanism is this: every dollar of invested income depends on the infrastructure of the person managing it. A person with $200,000 in index funds and a vague understanding of personal finance will make different decisions with that money than a person with $200,000 in index funds and a working knowledge of tax strategy, market cycles, and asset allocation. Same money, meaningfully different outcomes over 20 years. The top 10% spend more on knowing what they're doing. That spending shows up in their results. Here's the one I saved. It's not that the wealthiest 10% are smarter or harder working or more disciplined. In a lot of individual cases, they're not. What the behavioral data consistently shows is that they make decisions on a different time horizon. There's a concept in behavioral economics called hyperbolic discounting. Humans are wired to overvalue things that are available right now and undervalue things that will arrive later. It's not a character flaw, it's how the brain is built. The pleasure of buying something today feels more real than the abstract future benefit of not buying it. What the research shows is that this discounting effect is dramatically weaker in the top wealth bracket. Not because they're immune to it, everyone is subject to it to some degree, but because they've built systems and social environments that push against it. The clearest example of this in the data is market behavior during crashes. In the market downturn of early 2020, retail investors, individual people with brokerage accounts, sold at the bottom in large numbers. The week of March 20, 2020, Robinhood reported record sell-offs among its user base. The S&P 500 dropped 34% from February to March. Then it recovered fully by August. People who sold in March locked in their losses. People who held or bought more doubled their money in 5 months. Vanguard's analysis of account behavior during that same period showed that investors in target date funds, which are largely passive and don't make it easy to react quickly, mostly stayed in. Their outcomes were dramatically better than investors in self-directed accounts who could and did react to the news. The top 10% are not immune to panic. What they're more likely to have is a plan that doesn't require them to make a decision in the worst possible moment. The investment policy is set, the target allocation is defined. Rebalancing happens on a schedule, not in response to CNBC. On a longer scale, the difference in time horizon shows up in how they evaluate opportunities. When someone in the top 10% is deciding whether to invest in a rental property or a business or additional education, the question is usually, what does this look like in 10 years? When someone in the middle is making the same decision, the question is often, what does this look like in 12 months? A rental property has carrying costs in year 1. A business usually loses money in year 1. Additional education takes time away from current income. On a 12-month view, all 3 look questionable. On a 10-year view, all 3 can look excellent. The return on a $500,000 rental property held for 20 years in a growing market is a very different number than the return on a $500,000 retirement account in index funds, not necessarily better or worse, but different, and that difference matters depending on your tax situation, your income needs, your age. The point is that the decision was made with the 20-year picture in mind, not the 2-year one. That's the common thread across everything I've described in this video. Automating investments removes the short-term decision from the equation. Owning income-generating assets pays off on a multi-year horizon. Tax-advantaged accounts show their value over decades. Secondary income streams take years to build. All 7 of these behaviors are long-term bets. The wealthiest 10% are playing that game. Most people are playing a shorter one. Here's what I want to leave you with. None of these 7 things require you to be rich to start. Every single one can be done at some level on a middle-class income. Automate a contribution, even if it's small. Open a brokerage account. Max the HSA. Start one side income stream. Track your net worth once a month. Take one course this year. Make one financial decision based on what it looks like in 10 years. The gap between the top 10% and everyone else is real, but a significant part of it is behavioral, not just income-based. The behaviors are learnable. The honest question, not for me but for you, is which of these 7 you're actually doing. Not planning to do, not thinking about, actually doing. Because that's the gap. And it's closable. If this changed how you're thinking about your financial setup, the next video goes deeper on one specific piece of this: how to build an income-generating asset portfolio from scratch, starting with the first $10,000. That video is linked right here. Subscribe if you want it when it drops.